Well, hello, everybody. This is Ken Himmler, and welcome to another Wiser Money Show. This is January 2023. Welcome to the new show. Okay, well, before we wait any longer, hopefully you got my little post this morning on YouTube and some of the other various social channels. But I want to cover the normal show with you today, which is inflation, markets, touch on a little Social Security. Maybe I'll get to it. Secure Act 2.0 for sure. We're going to talk about some audit protection, new tax upload, and then Econ Map 2023.1. Hey, before we take too long, let's cover inflation and what the real inflation is. Our calculations are showing about a 10.5% trailing inflation. One of the reasons that this number is very different than what the government's is that the government does not use housing, food, or energy. I guess some geniuses sitting down there in the White House on Pennsylvania Avenue sit back and go, yeah, people don't have to live anywhere. They don't have to eat. They don't have to put fuel in their car. But they're saying it's about 7%, but when you include the other things that they're not including, it's closer to about 10.5%, 11.5% when you remove some of the government adjustments. What does that mean? Well, the government loves to play with these numbers because, again, you think about what the downside to inflation is for the government. They have to raise Social Security. They have to raise certain tax deductions with inflation. They have to raise government incomes and pensions. There's a lot of things that ride on COLA. So the cost of living increase adjustment. And so there is an incentive for the government to not increase inflation as much as it might be. And what I call the swap effect is, let's say that they're tracking filet mignon and it goes up by 20%. Well, what they'll do is they'll switch it out and they'll say, yeah, we're not going to track that. What we're going to track is hamburgers. So anyway, 8 to 10% potential increase in Social Security, and inflation is going to continue as long as they keep giving away free money and they don't force people to go back to work and by taking away that free money. Well, unemployment, 223,000 jobs added in December. Now, part is seasonal, and that number is not really trusted until we have a January net because that's where the layoffs come in. We have about a 3.2% unemployment rate. Again, that is probably not accurate because it doesn't count people that go off of Social Security or literally stop working from jobs. If you heard my post this morning, you'll know what I'm talking about. 7% if we're counting non-reporting unemployed. My biggest issue is not necessarily, well, it is, I guess, I do have a problem with the ridiculous low unemployment rate, but people just are continuing not to work. But it's mainly the productivity average. We're right now hitting about 49% in 2022. 2019, we had 62% productivity. That makes a big change. Let's get on to interest rates. Well, the Fed wants to increase inflation back to 2%. We have some more pop-ups in interest rates that are coming. And again, if you're looking at treasuries, 3 to 6 months, if you're looking at money markets, if you're looking at putting your cash to work, it will help you. However, I want you to remember that even though you might get 4% on a money market or 4.5 to 5 on a treasury, it still is losing a lot against inflation. Interest is going to take time for this increase. The interest rate increase is going to take time for people to run out of money. What I mean by that is when they increase interest rates and people are sitting on a ton of cash that they saved while the government was giving away free money. Because remember, for a couple of years, they just kept printing money during the COVID pandemic. And they just kept giving away money for free. Well, it's going to take about 6 to 9 months for some of that money to run out. And I don't think it's really going to affect the real estate for about 12 to 24 months. We still have, some interest rates that are in the 6 and 7s on mortgages, but we still have people that are swapping out houses while the house value is still high. That is supporting in a somewhat minimal way the housing market. Well, again, we got to stop this fake money. The politically motivated free money has to stop. Again, politicians are now have figured out how to weaponize the financial system into a political vote purchase. So I'll give you an example of this. The recent Biden loan forgiveness on student loans. Well, there was a recent study done by Pew that just showed that when interviewed, I think they did 1,000 people that were going to have their student loans forgiven. 62% said that they would just spend the extra money on travel and entertainment. So look, you can read this stuff where, these people are making $200,000 a year and they have no money. Well, I'm sorry, that they're just mismanaging their money. There's nothing more I could say about that. But if you have people that are paying off their student loans, and that means that the average taxpayer is going to spread the cost of what they're paying off, but those people that get that freebie, basically it's travel and entertainment. That's all it comes down to. Housing. Well, let's take a look at housing. Well, in May of 22, we see a mortgage rate pop up to 5.31 when in 2019 it was 3.17. That consumed 24.4% versus 15.7% of the income at that point. So as you can see, the affordability index has gone down quite a bit, and that was May of last year. Now, we do have a leveling out of the median home price, but we also have an increase in the mortgage rate. I don't have current numbers on this because this was May of last year, but I would presume that the affordability index has gone down probably below 100, which should push that real estate price even further down. If you ask me what my expectation is, and again, I can give you an expectation, but not in all markets. I mean, there are certain markets, and there might be Southern California, and there might be San Diego, and there might be certain places in Texas and Florida, and there might be certain places in the mountain towns where values have doubled, literally 100% increase. And I've seen that with the house that we have in the mountains. It has gone up in 2 years, 100%. It has doubled in value. Well, that is just ridiculous. So even if it came back 20% off the top, so if you take, let's say you take we'll just use an example, $1 million house, and it goes to $2 million, and you still take 20% off of $2 million, you still have $1.6 million. So it's still increased in value, but now it's down $400,000. It doesn't really change the affordability index unless the income keeps up with it. But the income doesn't keep up with it unless the inflation on goods and services is also balanced out. All right, let's jump over to the stock market real quick. And again, I can't tell you in a deeper conviction about how important it is to not look at year-to-year performance. I've had this discussion with a number of people, and you might have heard me even bring this up. I had this, I don't know what you call it, an epiphany. And it had to do with the drought in the West. So most of you know I live on the East Coast, and then we travel to the West Coast for skiing and mountain stuff. And well, the West Coast has had a pretty rough time of it. And, they've had a horrible, horrible drought. I mean, Lake Mead is down, whatever it is. They're finding dead bodies, and towns are, flooded towns are starting to show themselves. There's towns in central and north of California that have literally run out of water, and they've had to abandon the towns. It's pretty bad, right? And everybody says year to year, from December 31st to December 31st of the next year, here's what the rating is. Here's my question. Who came up with the fact that we humans can demark a weather pattern based upon our human-created calendar of December to December? Right? I mean, we think about this because all the news we have out there that's pelting us every day is about how the world's coming to an end because of climate change. Well, it's interesting because when you look back 100 years, the West has gone through in the 1920s. The West went through a severe drought, and then it did again in the 1940s. And so these events have occurred in the past. So when you look over a longer period of time, you can statistically show what the weather pattern rotations are. And guess what? It's not year to year. So now on the West, I think our house in the mountains, it's gotten over 350, almost 400 inches of snow this year, which is great if you're a skier like I am. But it's not. Last year was horrible, right? Last year it was virtually no snow at all. So who says that last year was a terrible season and it was because of the drought? Well, if you looked at the average of the 20 years, it's pretty averaged out. It's not much further off. Same thing with the stock market. Look, when we look at the stock market and we say, hey, oh my gosh, last year was horrible. Oh my gosh, last year the Russell was down 20%. Well, guess what? 5 years, it's still up 22%, 21%, which if you look at the average inflation over the last 5 years, it still has beaten inflation, which cash has not. And so now we go over into the S&P 500. Well, look, if I go year to date, right, it's up 6.18%. Again, this is how you have to understand, or this is why it's important to understand about how Wall Street can mess around with the numbers to mislead people to bad investments that are good for Wall Street. Look at this, 6.18 year to date. Now watch this one. If I bring this back into a year, well, now I'm down 6.14, right? So again, it's like the weather, but now when I go over a 5-year period, I'm still up about what, 9.25%. I'm guesstimating off here 9.5%. The bottom line is that if you understand how we invest in those three buckets, and bucket 1 is less than 5 years, bucket 2 is 5 to 10, and bucket 3 is 10 plus, right? Then you understand how volatility averages itself out over a period of time and why it's so important not to take Wall Street and the typical financial advisor or typical financial institution's advice of, well, look at this. You got an average of 8% rate of return on this stock. Well, that's fine if you're in the accumulation phase. Accumulation phase is different than the distribution phase. Now, when you're in the distribution phase, you can't mess around with years that you're down 20 or 30% on the prime accounts that you're trying to take cash flow from. Have you ever heard of something called reverse compound interest? Well, Einstein said that compound interest was one of the wonders of the world. Well, it is, as long as it's going up. But you have a couple negative years and you have to take cash flow out of that account. In those years you've lost, you're going to quickly accelerate the fallout, the run out, your sustainability. You're going to run out of money. So again, this is why those three buckets are so important to structure. And that's where I want to talk about that short-term reaction versus smart decisions. Last year, there always, almost 40 years I've been doing this, there's about 5% of the people that freak out when the market goes down. Sell, sell. We've never been in this environment before, right? This will be the decade of loss. I've heard this from so many people at the end of last year. Oh, the market is, it's going down. It's not going to return for 10 years. Well, it's up 6% already this year. Considering it was down 8.5% last year, we're not too far off from just evening out already. And let's not forget Bill Ackman, right? Back in 2020, I think it was May or April after the pandemic hit. He is the hedge fund manager for, I think it's Alliance, or I'm not sure who that is, but he's a big hedge fund manager, handles billions of dollars. And he came out all over the media, the world's coming to an end, the world's coming to an end. He did move the market. People freaked out. Well, what most people didn't know is he was shorting the market. I think he made something like $4 billion on the short because he got everybody to sell out. And then he cashed in his shorts and walked away to the bank laughing all the way. Well, smart decisions. Look, inflation, 10% is my guesstimate. My cash, CDs, and money markets, 4%, right? So why would somebody keep money that they knew was long-term money at 4% when inflation's 10? You're going to lose 6-7% every single year. And then taxes are always going to be the killer. So key indicator changes. New home sales down 25% just in October of last year. Personal savings rates are dropping. They went from over 6% to 2%. Haha, 1921 flu epidemic. Well, technically what? 1918 to 1921. Technically, we're seeing the repeat. If you don't know what I mean, go back to some of the broadcasts that I did of the Wiser Money Show back in March, April, May, June of 2020 when the pandemic hit. I said, watch, this is going to be a complete repeat of the 1920 flu epidemic where people get locked down and they build up all this money. They have pent up energy. Then as soon as it's released, they go out and they spend tons of money. Inflation goes up, but they keep spending. And then what happens is they start running out of money. When they start running out of money, now here's the difference. Back in 1920, we didn't have this free government money. That's why you remember seeing the Great Depression with people sitting in soup lines, because there was no free money. There was no Section 8 housing. There was no food stamps. There was no welfare system. It was a mess, right? Well, that's the difference with today. Now the government just prints more money, gives it to people so they can sit home and watch video games. However, the personal debt per capita, that's increasing. So this is one of the things we've got to watch because this did happen back in the flu epidemic. Interest rates for mortgages increased to 7%. More to come. Property taxes way up. Insurance way up. All these people that ran out there and bought, real estate. Oh, well, I bought a $500,000 property. It went to $900,000. And then when they bought the property, their property taxes were $5,000, and now they're $9,000. Insurance, holy mackerel, have we ever seen an increase in that? Our insurance just on our little home in Florida because of the hurricanes has almost doubled in cost. So you got to be prepared that real estate can have fluctuating costs and fluctuating rates of returns. It is going to be unaffordable for a lot of people to keep the properties that they bought. We saw this during 2008, right? When those variable rate mortgages came due, the property taxes came due. People just walked away from their properties. And again, we have got to stop. And how do you do that? Well, you write to your congressman, your congressperson, and you say, stop the freedom or stop the free money flow. Just stop it. Stop giving away free money. I'll vote for you without buying the votes, right? All right, let's jump into the Econ Map 2023 version 1. Oh, if you've been following this for the last 3 years, you know that this has hit about 85% accuracy. But I added a new one in here. See that under 2023 and 2024? See that supply chain free money? It's now overlapped with a new problem. We started off with in 2020, the election and vaccine. Then in 21, growth depends on vaccine and taxation. But we had a supply chain problem with free money. That happened during 2022, which pushed prices up and soared inflation. Now we have another problem, the weaponization of free money to get votes no matter what the cost. So what I see is really going to be the battle in our economic success is the crushing of socialism. Because you cannot just give away free money and expect everybody else to pay for it that works twice as hard. We're supposed to be a capital-based market, capitalism, which means that the money and the spoils and the benefits go to those who work the hardest and the smartest, not those who just show up. It's funny because when I was raising my kids back in the 90s, that was when the whole trophy mentality came out. Just give every kid a trophy just for showing up. Completely disagreed with it then. Disagree with it more now. Nobody deserves a trophy for showing up. You deserve a trophy for doing something for somebody else. Well, now we've got a couple fundamentals that I called out last year. It hasn't changed much. Here's exactly what I came out with. And again, this version right now has been in place since February of 2022. I'm going to show you the only market that I changed on here is going to be that I added socialism to the fight to sustain our economic ability. But this has not changed. In February of last year, I predicted that the market would take this really deep dive, and it did. It went down 30% in the summer, and then it recovered. And you can see here, I said we're going to probably play this little level game all the way up until mid to end of next year, probably second to third quarter. Because again, let me explain this. When we see a stock market increase at unprecedented rates, there is no fundamental reason for that. Now we see Microsoft laying off 15,000 employees. Amazon, I think it was 18,000 employees. Google, 15,000 employees. And you know what's interesting is there's always going to be some whiners in the crowd. Always. I read this little article from some Google engineer that said, oh, I've worked for Google for 15 years and, they just laid me off. How rude, how insensitive. Here's my question for you. Were there other engineers that they kept? Of course they did, because they need engineers, which meant that the reason that they laid you off is you didn't perform like the other engineers. So guess what? You don't deserve the job. Your job goes to those people that perform the best for Google, because then Google can perform the best for their customers. So honestly, I'm so sick and tired of all these people whining out there like, oh, I was fired for this or fired. Guess what? If we don't perform, then that's what the outcome is going to be. And so again, I don't see the downside to the stock market when all these companies are laying off. Look at statistical history. Every time companies lay off in masses, the market goes up. Why? Well, those companies become leaner, meaner, more profitable. Those companies are now able to do the same things that they were able to do before without that overload of employees. So I think that these giant layoffs, they're great. They're really, really good. And it's going to shake up some people that maybe weren't performing. So maybe the next job that they go to, they can do better. And then the productivity goes up. And then we become stronger. So again, I see these layoffs as being really good for the stock market, but it's going to take 6 to 9 months for that to filter out. Because while the market can jump up and down daily, these kinds of changes take a little while for them to show the profitability within the companies. So again, right now, productivity way down. But I see this crossover when the market starts to go up, when productivity starts to go up. Inflation's going to go up until we stop giving away the free money. So again, I think these layoffs are fantastic because I think that they're going to help everybody in the productivity, in the inflation rate, and leveling out of interest rates, etc. Now, some people have asked me, well, when do you see real estate really adjusting? I don't see it until probably the third quarter of 2023. And I think if you're going to really peg when you go start buying investment property, again, when I started talking about this years ago, when the pandemic hit, I said, look, if you're going to exchange a house and you have a $800,000 house and you're going to change it for another $800,000 house, no big deal. The only downside is if you live in a state which has a cap. Like in California, you got a Prop 21, and Florida, you got a 3% increase max. Nevada, you have I think it's 2 or 3% increase. If you have some locks by your homestead, that's different, because if you move from a $800,000 house, which you have a tax assessment base of $300,000, and you exchange that for an $800,000 house, you probably just tripled your property tax and certainly increased your homeowner's insurance. But what I was referring to 3 years ago is investment property. Okay, I see that big opportunity of circle of opportunity coming up here, probably getting closer now, 6 to 9 months away. All right, 2023 estimated actions. Well, now with Secure Act in place, because that got passed this month, we must change every single trust. If you are on the trust amendment package, guess what? We completely rewrite that trust for you for free. There's no additional cost to you. If you're not on it, you're going to have to get your trust completely amended, ripped apart, and started from the beginning, because now all the tax laws have changed. We're going to be working on that in the first, second quarter of this year. What do we do on the economic front? Well, between February and June, we got to watch the debt ratio per capita. We got to watch interest rates. And for those of you that are nearing or are in the distribution phase, got to recalculate cash flows. First quarter 2023, one of the things we're going to be doing is changing some of our equity allocations and reducing some of our international allocations and increasing domestic coverage. Okay, here's a little note. We will be sending out some emails. If you're on our email list, we'll be putting some invitations on YouTube and some of the social networks that we publish this stuff out to. But on March 1st, 2023, we are going to do a full in-depth. This is where you get to get online with me and ask questions. You get to say, what if I did this and what if I did that? Because there are so many things that have changed with Secure Act 2.0. You can convert an HRA to a Roth or to an IRA. You can convert company Roths to an IRA. There is now definitions on a required minimum distribution for a beneficiary. There's changes in how you can actually use backdoor Roths. There's changes in the estate tax. There's changes. There's so many changes. I can't even. That's what we're going to do, a webinar on March 1st. So what we're going to do is after you complete that webinar, we're going to give you a certificate worth $1,200. And this is for a one-on-one discovery meeting with one of our CPAs or CFPs. That gives you a full 2 hours of analysis, questions, interaction, and whichever CPA or CFP that you're meeting with, they're going to run full software calculations of what you could take advantage of with Secure Act 2.0. So here's one of the reasons why I'm doing this. Well, we do a lot of these webinars, we do a lot of education, we sell a lot of online courses, but what we're finding is that people just don't want to figure it all out. So we can sit there and teach from like a classroom style and then say, go do these things. And then what we do is we find people don't. And because it's so comprehensive. So what we're going to do is we're going to give away 2 hours of time with one of our CPAs. Now, that's because they would normally charge you $1,200 for that full analysis and Secure Act 2.0 action list. And there's no commitment. There's no cost beyond that. If you want to extend your hours, well, that's up to you to decide with one of the CPAs or CFPs. But you're going to get that full analysis. And then you're going to get a to-do list. Now, because of the time, I think we have 36 people on staff now. We're only going to be able to offer that to the first 100 reservations. Obviously, we can't do it for 1,000 people. We just don't have the manpower, people power, women power to do that. So it's only going to be for the first 100. When you get that invitation for the Secure Act 2.0 webinar, you'll see the definitions of there. All right, actions to take now. Secure Act 2.0, you got to get up to date with it. Automated financial management, you've heard me talk about this. You better get your house in order because the IRS is going to come a-knocking. And when I say that, you better assure that your receipts, your books and records, we are seeing a 400% increase in IRS notices. We're seeing a 200% increase in audits. And these audits, they're some of the most ridiculous things I think I've ever seen. They're literally training new IRS agents by auditing people randomly. And they're putting them through, you know what I was going to say, right? It's just horrible what I'm saying. However, if you have everything in order, and I mean everything, and I tell you what, we see a lot of people with some messy books, some messy deductions, some messy receipts, bad ways of doing things. So I'm telling you, get that house in order 2023. Also, using rolling ETF bonds, capture the uptick in rates. So that's one of the things people keep asking me, well, should I go to cash and CDs? And listen, if you got at least a 2-year window, 2 ETF rolling bonds are a great way to not get stuck in an interest rate risk with a bond. Hey, before I wrap up today, if you haven't yet subscribed to the H&H Financial channel, all you got to do is just Google H&H Financial Center on YouTube, hit that red subscribe button, and you'll get notices when I upload stuff. And with that in mind, you got any questions, give us a call. It's 844-702-1040. Hey, have a great weekend.